Welcome to the March RCA Institute webinar and discussion. Today, we'll be taking a bit of a whirlwind tour of an introduction to RCA modeling. Now, this is going to be very quick. It's going to be kind of high level, and sorry, I'm messing around with admitting people to the webinar for a second. And it'll be followed next month in April by a part 2, which goes into a little bit more depth. My name's Larry White. I'm the Executive Director of the Resource Consumption Accounting Institute. And we are recording the presentation part of this. When I finish the presentation, I'll turn off the recording for any questions, comments, and discussion. And if you happen to have a question or comment during the presentation, feel free to use the chat feature, but I won't be able to look at it until I'm finished presenting. So let's go ahead and get started. Resource consumption accounting is based on German management accounting techniques known as GPK, or Grenzplan Kostenrechnen, and also incorporates the process view when it's valuable of activity-based costing. RCA creates an integrated model of operations for internal decision-making. So the focus is on internal management decision-making, linking operational metrics to money, and also reflecting clear cause and effect relationships. And by that, I mean operational and resource relationships, not just financial reporting rules and standards. Let's start with a simple diagram. This is from the IMA's conceptual framework for managerial costing. And RCA follows that conceptual framework. RCA is based fundamentally on two principles: causality for modeling and analogy for information use. We start with understanding the output of the organizations based on the organization's strategy and strategic decision-making. And then we build a model of the resources. The core of RCA is an operational model that serves as a baseline for optimization decisions to help an organization achieve its strategic goal. So we're going to talk some more about this idea of an operational model that is then costed, and that sequence is important. In support of the two principles, causality and analogy, RCA has techniques to apply the supporting concepts. These concepts come from the conceptual framework of managerial costing. And naturally, we recognize that there are a number of constraints that will have to be considered as well. Time doesn't permit me going deeper into all of these. The IMA's conceptual framework for managerial costing is available on the IMA website at imanet.org. But the goal of this is to focus on representing the reality and economics of operations for internal decision-making. That means unimpeded by accounting rules and standards. So how does RCA modeling work? Well, first, the idea is to identify the resources, then identify the resource relationships. And then at that point, you have an operational model. Then you apply costs to the model. And that may require not just going to the general ledger, it may actually require collecting data that previously hadn't been collected. But the idea is that the cost information needs to reflect the operational model. That gives you an operational model that's costed, and all of that means visibility for better decisions. So let's go into the modeling a little bit. So this kind of abstract picture is meant to represent the idea that organizations have a variety of resources that are organized to produce the sellable goods and services. Now, if we look at this diagram, we see down towards the bottom that everything's a little more organized. And then if you think about it, in the in the production areas, in the direct service providing areas, everybody pretty much knows the process and the flow. Whereas up at the top, we're in the support and administration areas, and their relationship to everything is often a little muddled or nebulous when you try to pin it down. So the first step is to organize the resources into articulatable resource pools in a logical manner. And the arrows are meant to reflect that you're looking at where those resource pools provide their output as support. Now, there could be more than one arrow out of many of those resource pools. That's not at all unusual. RCA has a variety of techniques and guidelines to support creating resource pools and deciding how discrete or broad they should be. So let's talk about resources for a minute. We need to be aware of resource characteristics. And the way we look at this for RCA is resources have three core characteristics. The first is the capability. This is often what you might call quantitative techniques or qualitative techniques, the level of technology that the resource is, the production characteristics. Let's take an example of two accounting technicians that are resources. One accounting technician may be very fast at doing simple transactions. That's high productivity, that's good. Whereas another accounting technician may be slow, but they're able to solve all the hard transactions, the ones that come in with flaws and need some rework. So they have different capabilities, but they're both valuable. Of course, capacity. A resource is only available for a certain amount of time. We use theoretical capacity in resource consumption accounting, which means that a resource that you own is available to you 365 days a year, 24 hours a day, whereas there are some resources you hire and lease that are only available for the contracted or agreed upon period. We also think of it in terms of productive, non-productive, and idle or excess. Productive time is when a resource is doing the thing you paid it to do. You hired it to do. So an accounting technician doing accounting transactions. Non-productive time is by no means wasteful. It's time that's required to maintain or train a resource. So for an accounting technician, that might be training time of various sorts, either on skills or on things like diversity or various sundry things, workplace safety of some sort. For a machine, of course, maintenance time is non-productive time. Critical, but non-productive, not doing the thing you hired it to do. And idle or excess time is when you don't have work for the resource to do. So, and then the last one is the consumption characteristics, and that defines the relationship to output. And we think of that in two terms, primarily the operational quantity, how much time or how much resource quantity is required to produce the specific, a unit of the specific output that that resource or resource group creates. And then, of course, you associate cost with that. So how do we do this? So first you define a resource group primarily by a group of resources that produces a fairly homogeneous output. So what do we mean by that exactly? Well, think of a resource group perhaps as service one. So you have a resource group that provides a particular service to the organization, some production resource pools, some other service resource pools. RCA uses the concept of responsiveness from the conceptual framework of managerial costing, where resource characteristics are traced from resource pool to output based on fixed and proportional relationships. So as you can see, resource service one has a bubble down below it that shows the characteristics of its fixed and proportional the inputs that come in order to produce the output. Now, this isn't the way most people learn costing or even use this sort of diagram. What you typically see, fixed and variable are typically viewed only in relationship to a final output, a product or service. And when you do that, it hides a great deal of information. We call this approach to looking at fixed and variable variability. And it's actually why you won't hear me use the word variable, except when I make this in explanation. Because what happens is, as you can see, all those resource pools are plugged together, and only those costs that kind of change based on product. Whereas, as we saw before, there's a whole bunch of things going on inside the organization that you can't see when you lump them all together. So we don't use this concept of variability. We use a much more discrete concept of responsiveness. So how was that done? Going back to our example, the resources in the pool are evaluated for the fixed and proportional relationship with the resource pool's output. So each one's evaluated. Let's say the dark line is the solid line is the fixed and the dotted line is the proportional. Now, I just have to stop and remind you, at this point, we're not actually talking about money. We're talking about the units of the resource, the operational quantities of the resource. We haven't even gotten to where we're talking about money yet. We're making the operational model. So then, very simply, the relationship is summarized into the fixed and variable, the fixed and proportional costs leaving the resource pool. What's this look like on a spreadsheet, just so you can get a sense of it? So first, we have a plant maintenance resource pool. Its output quantity is 20,000 hours of maintenance labor hours. So we look at the resources that are within this resource pool. We have technician wages, supervisor salary, general material, and some depreciation. And we're not going to talk about this, but RCA has particular ways of handling depreciation to reflect the idea of theoretical capacity. But in this case, the technician wages are 600,000 and they're proportional. So they change based on the level of output. The supervisor's salary is fixed. Have the same supervisor no matter what the level of output. The general material has a fixed and a proportional component, and of course the depreciation or the capital use replacement is fixed. So that's just gives you a sense. So let me just remind you where we are. What we're doing is we're looking at one of these resource pools and we're trying to assess what it takes to represent the output from it. So in addition to what we call the primary consumption relationships, there are secondary consumption relationships. Resource pools don't stand alone. They are often supported by other resource pools. So other amounts of fixed and proportional resources come in and support any given resource pool in its production effort or in producing its output. So how do we represent this? Well, we look at, we call them secondary costs, and some of them might come from other resource pools, say a utility. In RCA, we also have activity or process I'll call them drivers for lack of anything a better word, but there are ways to transmit. And we see that what we do is we reevaluate these. We see how much comes in and we check its characteristics when it leaves. Because sometimes when a resource pool consumes the output of another resource pool, it changes the nature of it usually from proportional to fixed. So fixed costs become more prevalent as you move through a value chain. Now, there are other things we could put on here, floor space. There could be lots of other things that go into this, but I just kept it fairly simple to show some of the things: utilities, HR, benefits adjustments, purchases for general purchasing functions for general materials. This isn't the general material. This is just the purchasing resources that buy the general material. So when we're all done, we typically have a diagram that looks something like this, with the other resource pools providing support to a resource pool, the resources in the resource pool producing the particular output of that resource pool. It doesn't need to be a product or service. This can be an intermediate resource pool somewhere along the value chain. So how does let's just summarize a little bit here. An RCA modeling identifies the resources. It identifies the resource relationships. It maps the cause and effect relationships between resources. It maps the flow of resources as fixed or proportional. And it is possible to have other sorts of relationships than just fixed and proportional. There could be some that are exponential or things like that, but that's the most common representation. After we do those two things, you have a cause and effect based model of your operations, and you can see many resource capacity issues and perhaps opportunities at this point. And then you go in and you apply the costs to reflect the operational model. Okay, so let's look at one more simple example to reinforce this, and then we'll wrap it up. In this example, you have an indirect resource pool, an indirect resource pool, a direct resource pool that somehow produce a product or a service. So the indirect resource pool supports another indirect pool and supports a direct pool. The second indirect resource pool uses an activity to support the product or service directly, There are also potentially non-causal costs. Maybe excess or idle capacity might be a prime example that aren't applied to the product or service. They're applied to a P&L level, a level of the organization, because you don't want to muck up your product and service costs. That's why sometimes you see product costs or service costs change with mix and the nature of the products. So RCA eliminates that. This is not done, there's no allocation here. These are either causal assignments or non-causal costs are brought to an appropriate level of the organization so that there's no distortion. Also, remember, all these arrows represent fixed and proportional costs. So this is a little example from an actual project. I know you can't read it. I'm just going to give you the high level overview. The green block is the block of support resources. The pink block is the production resources. The yellow block is the products or services. And this gray block is what we call the multidimensional matrix of costs, because RCA produces enough information that you might want to do product costs, customer costing, distribution channel costing, and all of that can be factored in. This purple block over here, we're going to pretend it doesn't exist, but for this particular example, there was a lot of byproduct that was reusable later in the chain, so there had to be a way to manage that and bring it into the model. So wrapping up, this diagram is from the International Federation of Accountants a paper on a costing continuum. Resource consumption accounting was rated as the top method, just short of full real-time simulation. I would argue that if you're going to do real-time simulation, you will need to use RCA techniques. And in fact, RCA has been used in pretty darn close to real time, within minutes anyways. And you see it provides a level of demand-driven planning and capacity sensitivity that other methods can't provide. I would also argue that RCA is not fabulously more expensive than any of these other methods. It really just, you don't have to go through a progression. You just have to start with the end in mind that you want to achieve. So I hope I've given you a bit of an overview of how RCA modeling works. We'll go into some more depth next month on this. And at this point in time, I'm going to turn off the recording.